Stop what you are doing and look at your portfolio. Seriously, pull up your brokerage app. Because the rules of the game just changed. For the last 12 months, we've been living in a fantasy land. We thought the inflation war was over. We thought the Federal Reserve was independent. We thought the soft landing was a done deal. But as of this morning, January 31st, 2026, those assumptions are dead. After waiting in the wings for a decade, Kevin Warsh has finally clinched the nomination to be chairman of the Federal Reserve. President Trump has made his pick. But this isn't just a job placement. This is, in Warsh's own words, a regime change. Warsh convinced the White House that he has a magic bullet, a way to slash interest rates, print money, and somehow not cause inflation, thanks to an AI productivity boom. It sounds too good to be true. And if you know anything about economic history, when things sound too good to be true, someone usually ends up holding the bag. That someone is you. The Fed has hit the pause button on rate cuts. Wall Street is paralyzed. And behind the scenes, an unprecedented war is breaking out between the Treasury, the White House, and the central bank that controls the value of the money in your pocket. We are staring down the barrel of the most dangerous economic experiment since the 1970s. Will Warsh's gamble ignite a new golden age, or are we about to witness the collapse of the bond market and the return of double-digit inflation? Buckle up. We're peeling back the layers of the Fed's hostile takeover. Let's set the scene, because the context here is everything. It's January 2026. President Trump has been back in the Oval Office for exactly 1 year. Late last year, we got what everyone wanted, 3 interest rate cuts. The market rallied. Your 401k looked great. But then, reality called. Earlier this month, the data turned ugly. Inflation is proving to be stickier than superglue. The labor market is stabilizing, meaning wages are still high, and growth expectations for 2026 are heating up. As a result, the current Fed policymakers slammed on the brakes. They paused rate cuts in January. Traders in Chicago and New York aren't pricing in another cut until June at the earliest. This is the nightmare scenario for the White House. Trump demands cheap money. He wants low borrowing costs to fuel the construction boom and the reshoring of manufacturing. But the data says no. Enter Kevin Warsh. Warsh beat out the competition, including White House insider Kevin Hassett, by promising something radical. He didn't just promise to be a loyal soldier, he promised a complete overhaul of how the Fed works. He sold Trump on a theory that defies traditional economics. But here is the billion-dollar question: can he actually deliver? Dario Perkins, a top economist at TS Lombard, calls this the winner's curse. He said, the last thing an economist needs is to be given an opportunity to put their theories to test. Why? Because if Warsh is wrong, he isn't just ruining his reputation. He's risking a sovereign debt crisis. To understand why this is so dangerous, we have to look at the man himself. Kevin Warsh is a paradox. And that paradox is about to become your problem. If you were investing during the 2008 financial crisis, the name Kevin Warsh should ring a bell. He was the youngest governor on the Fed board back then. He was in the trenches with Ben Bernanke. He helped broker the sale of Wachovia to Wells Fargo. He was the architect of the bank bailouts. But here is the twist: for the last 15 years, Warsh has been a hawk. In financial speak, a hawk is someone who hates inflation and loves high interest rates. When Ben Bernanke started quantitative easing in 2010 to save the economy, Warsh hated it. He resigned in 2011 because he thought the Fed was being too loose with money. He spent the last decade writing op-eds for the Wall Street Journal warning that the Fed was going to cause hyperinflation. So, let me get this straight. The guy who spent 10 years screaming that interest rates were too low is now the guy Trump picked to lower interest rates? How does that make sense? It makes sense because Warsh is a political animal. He knows what the boss wants. Since Trump returned to office in January 2025, Warsh has suddenly pivoted. He reportedly told Trump in December that he favored more cuts. Critics are calling this a massive flip-flop. Peter Conti Brown, a Fed historian at UPenn, put it brutally. He said Warsh's recent writings suggest that the rules of monetary gravity no longer apply to the Fed when Trump is in the Oval Office. This is terrifying for the bond market. The bond market relies on trust. They need to know that the Fed chair will fight inflation, even if the president screams at him. If investors think Warsh is just a puppet who will cut rates whenever the White House asks, they will sell U.S. treasuries. When people sell treasuries, yields go up. And when yields go up, your mortgage rate goes up. So, even if Warsh cuts the official Fed rate, if the market doesn't trust him, the real interest rate you pay on a home loan or a car loan could actually skyrocket. It's the Liz Truss effect that nearly destroyed the UK economy a few years ago, coming to America. But Warsh claims he has a secret weapon. A reason why he can cut rates without causing inflation. And that weapon is 2 letters long: AI. This is the core of Warsh's thesis, and it's the most seductive economic narrative in the world right now. In a podcast last month with Avon Financial, Warsh said, "This is the most productivity-enhancing wave of our lifetimes, past, present and future." He is betting the house on artificial intelligence. Here is the economic theory: inflation is caused when too much money chases too few goods. Usually, if you cut interest rates, people spend more money, and prices go up. However, if companies use AI to become massively more efficient, if robots and algorithms can produce twice as much stuff for half the cost, then prices fall. This is called a supply-side productivity boom. Warsh is arguing that AI is going to make the American economy so efficient that we can have high growth, low unemployment, and 2% inflation all at the same time, even with lower interest rates. He wrote in the Wall Street Journal that fundamental reform would unlock the benefits of AI to all Americans. It sounds great. Who doesn't want a booming economy with cheap tech? But there is a massive problem with this theory. Timing. Productivity booms take years, sometimes decades, to show up in the data. We are seeing AI adoption, yes. But are we seeing it drive down the cost of bread, milk, and gasoline today? No. If Warsh cuts interest rates in 2026 based on productivity gains that might happen in 2030, he is pouring gasoline on a fire. Stefan Koopman over at Rabobank calls this bluff. He says Warsh's plan offers an easy way to sound hawkish, while providing cover to later advocate for the rate cuts this White House wants. It's a smokescreen. And then there is his other controversial proposal: shrinking the balance sheet. Warsh has pledged to reduce the Fed's massive portfolio of bonds. He argues that if the Fed stops manipulating the bond market, the economy will be healthier. But wait, shrinking the balance sheet usually raises rates. It pulls liquidity out of the system. Warsh is trying to argue he can tighten with one hand while loosening with the other. It's an incredibly complex maneuver. It's like trying to land a 747 on an aircraft carrier while the engine is on fire. If he gets it wrong, liquidity dries up, banks stop lending, and we get a repeat of the Silicon Valley Bank crash or worse. Now, let's peel the onion back one more layer. This isn't just about economics. It's about power. While Warsh is preparing to take the throne, the Trump administration is laying siege to the Fed's fortress. We are seeing reports of an unprecedented Department of Justice investigation into the Federal Reserve. What are they investigating? Overspending on renovations to the Fed's headquarters. Let's be real. The Justice Department doesn't launch a probe into office renovations unless they are trying to send a message. This is a pressure tactic. It's the government holding a sword over the heads of the current policymakers. It stokes fears that Trump is seeking to fundamentally remold the U.S. central bank. And he has help. Treasury Secretary Scott Bessent is leading the charge. Bessent has repeatedly accused the Fed of straying from its mandate. He's not just talking, he's proposing changes to who gets to lead the 12 regional reserve banks. Why does this matter to you? The 12 regional banks are the voices of Main Street. They are usually more independent than the Washington board. If the White House takes control of the regional banks, they control the entire system. Mark Spindle, who wrote the book on Fed independence, says the chair has immense control over research and staffing. If Warsh wants to, he can engineer replacements to district bank presidents. We are looking at a potential purge of anyone at the Fed who disagrees with the low-rate agenda. Donald Cohn, the former Fed vice chair, tried to be diplomatic. He said Warsh will need to use his considerable skills to marshal evidence to convince the other voters. Because remember, the Fed chair isn't a dictator. He has one vote on the FOMC committee. Warsh needs a majority to cut rates. But if the White House is threatening DOJ investigations and firing staff, how many Fed governors are going to be brave enough to vote no against Warsh? The independence of the Fed, the only thing separating the US dollar from the Turkish lira or the Argentine peso, is hanging by a thread. So, what does this mean for your money? Let's look at the best case, the worst case, and the likely case. Scenario A, the Goldilocks AI boom. In this scenario, Warsh is right. AI adoption accelerates faster than anyone predicted. Companies slash costs. Inflation naturally falls to 1.5%. Warsh cuts rates to 3%. Result, the S&P 500 goes to 7,000. Tech stocks go parabolic. Real estate booms again because mortgage rates drop to 4%. Everyone gets rich. Probability, low. It relies on technology moving faster than inflation, which is a massive gamble. Scenario B, the 1970s redux. Warsh cuts rates because the White House tells him to. But AI productivity doesn't offset the cash flood. Inflation spikes back to 5%, then 8%. Result, the bond vigilantes wake up. Investors sell US debt. 10-year Treasury yields hit 6% or 7%. Impact on you, mortgage rates hit 9% or 10%. Housing prices crash because nobody can afford a loan. Stocks tank because inflation eats corporate profits. Your grocery bill doubles again. Probability, moderate to high. This is exactly what happened when Arthur Burns bowed to Richard Nixon in 1972. Scenario C, the institutional gridlock. Warsh gets the job, but the Senate confirmation is a bloodbath. A key Republican lawmaker has already vowed to block nominees until the DOJ probe is resolved. The Fed is paralyzed. The market hates uncertainty. Result: volatility. Massive swings in the stock market. Businesses freeze hiring because they don't know what the cost of capital will be in 6 months. Probability: high. The market is already voting. Did you see the Bloomberg survey from December? The majority of economists wanted Christopher Waller, the safe, boring choice. Only 13% favored Warsh. Wall Street is telling us they are scared of this appointment. They see Warsh as a political operative, not a steady hand. And let's not forget the deficit. The US government is borrowing trillions. If Warsh cuts rates and shrinks the balance sheet, who buys that debt? If the Fed isn't buying it, and foreigners get scared of inflation, we could see a liquidity crisis where the US government struggles to fund itself without offering massive interest rates. So, what should you do? We are entering a period of regime change. The old rules of don't fight the Fed are getting complicated because we don't know who the Fed is anymore. Is it an independent bank, or is it a wing of the Treasury Department? Here is your watch list for the next 3 months. 1. The 10-year Treasury yield. This is the most important number in the world. If Warsh speaks and this number goes up, it means the market thinks he's going to cause inflation. If it hits 5%, run for cover. 2. Gold and Bitcoin. If the market loses faith in the Fed's independence, these hard assets become the hedge against a devalued dollar. Watch them closely. 3. The sticky inflation numbers. Ignore the headline CPI. Look at supercore services inflation. If that stays high, Warsh has no economic justification to cut rates. If he cuts anyway, you know it's purely political. Kevin Warsh has waited a decade for this job. He's betting his legacy and your financial future on the idea that AI will save us from the consequences of easy money. He might be the visionary who ushers in a new era of prosperity. Or, he might be the man who accidentally breaks the US dollar. The Fed has paused. But the clock is ticking. I want to hear from you in the comments. Do you trust an AI-driven economic boom, or is this just an excuse to print money? And are you buying or selling this market right now? If you want to stay ahead of this chaos, make sure you subscribe and turn on notifications. The financial landscape changes daily, and you cannot afford to be asleep at the wheel. Thanks for watching. Guard your wallet. I'll see you in the next one.